we're going to go ahead and get started. What we're going to do is spend about 30 minutes on actual webinar content. I'm going to hand off to Michael, and then he'll hand off to me. The two patterns that we're going to be covering tonight are going to be one bullish pattern and one bearish pattern. And the bullish pattern we'll be covering is the one that Michael will be discussing. That's the piercing line pattern. And the bearish pattern will be the one that I'll discuss, and that's the dark cloud cover. These are basically variations of one another, and they're actually kind of related to the bullish engulfing pattern and the bearish engulfing pattern that we discussed previously. So with that, I'm going to go ahead and hand off to Michael, who will start out by discussing the piercing pattern with us. So let me just change presenters. You guys should see your screen flicker for just a minute. Throughout the course of the presentation, if you want to write in with your questions, we're happy to take those. We'll save those until the end. And in the last 15 minutes or so, we'll go ahead and take a look at what those questions are and answer any of those that might be pertinent for everybody involved.
Okay, Julia, can you see my stock finder?
I can.
Cool. Well, for those of you that haven't discovered it yet, there is a library of candlestick patterns in here. I imagine Julia's talked with you about these in previous, but I'm just going to go ahead and show you in our library of conditions and indicators. There's a rather extensive library, better than 70 patterns that you can see, and all of those are available for you to use in the same kind of ways that we'll use them tonight, just so that you know that they're there. If you look at the chart that I have showing of Huron Consulting Group, you see a really classic example of what's called the bullish piercing line pattern. It's a two-candle pattern, and I'm going to try to give you some notes over here on my scratch pad so that when you watch the archive again, you can kind of brush up on it. But it's basically the opposite of the pattern that Julia will look at, the dark cloud cover pattern. So these are basically the opposite patterns. One is bullish, one is bearish, one is at the bottom of a downtrend, one is at the top of an uptrend. The piercing pattern that you're looking at basically has these kind of characteristics. First of all, it's only valid if it's at the bottom of a downtrend, whether that's an extended downtrend or just a pullback in an uptrend. It's got to be at the bottom of a downtrend. The first candle of the pattern is always going to be very bearish. That's the dark candle or the clouded in candle that you see at the bottom, at the inside of my little rectangle there. And you can see it's longer than most of the candles that you see on the chart. So it's extremely bearish looking, and it's at the bottom of that trend. Both of these candles are going to have larger bodies than the normal range on a consistent basis. Then the second candle, one of the real key characteristics is it has to open lower than the low of the previous candle. So basically it's going to gap down. So you're getting rid of all of the sellers, you're flushing those out. It gaps down and may even be driven down a bit. That's why you've got the wick on the bottom. But then that day, the bulls step in, move it much higher. And in order to qualify as a pattern, it has to get basically above the halfway point, which visually is somewhere in that area, the halfway point of that down candle. So to qualify, it has to close over halfway up the body of the first or the bearish candle. That's kind of what defines it. However, it doesn't engulf that whole candle. I mean, if it did that, it would be a bullish engulfing pattern. This is why they're fairly related. So you get a negative downtrend of some sort. You get a big bearish candle down. You get a gap down to the open. Then the bulls take it over and drive it up, and it closes at least halfway up the previous bearish candle. There are a couple of things that strengthen this signal. The farther this gap is at the bottom, from the bearish candle to the bullish candle, the farther that gap from close to open tends to indicate the strength of the reversal that's going to follow. And then the farther this bullish candle penetrates up into the previous bearish candle also is going to be a pretty strong indicator. Now, if one or both of those candles, especially the bullish candle, happen on a lot of volume, that's a really good sign too. Ideally, what you're trying to do here is you've got a strong or dominant downtrend, you've got a bearish mentality, then you get that big negative candle, and it kind of scares people. and so the bears really rush in, trying to get rid of it. There's some panic selling at the bottom. When the bulls take over and they react so violently on that second candle, it kind of shocks. It has a shock factor for the bears, and that tends to feed the change in mentality, which is really what we're talking about here. It's just a change in the mentality of the traders about this particular stock. Now, there's a few little things I also want to point out. Then we're going to actually scan for these patterns, and we're going to take a look at them. These are things that are good to know. You want to have some consecutive down days. This is a really great example of it here on the chart in this downtrend that we see here. Excuse me. Notice how many of the candles are filled candles, and it's a rather strong downtrend. Ends in that really long negative, really bearish candle. That's a really good sign. That's what you want to see when you're looking at this pattern. And that last candle, you really want to look bearish, and you can see it's close to twice the size of the range of most of the candles that you have showing in the history that I've got on the chart. So it's pretty negative. And then that next candle really needs to be a surprise, and you can see there's a big gap down between the close of the bearish candle, the open of the bullish candle. The bears are still thinking at this point that this thing is tanking. There's maybe some shorts in this by now, and then the bulls run it up really hard, and that's a bit of a shock. That's a bit of a surprise, and that's a really good thing for those of you that are going to be playing this bullishly. Now, a couple of other things. This example that we have on the chart looks great. I wish they all worked that well. Just a complete reversal. Great move afterwards. They don't always look like that. They may move up and they may pull back. Julie and I were talking beforehand. She said, you know, a lot of times these patterns turn into support at the bottom or resistance at the top, and that's a very good point. You'll see that in some of the charts, that this area where this pattern is becomes a point of support. So you might get a move up, you might get a pullback into that area, and then you might get a stronger move forward. If they all worked this good, we'd be really happy and we'd all be hunting them, but they don't all work this way. By the way, like I tell my classes, that's why things like this are called technical indicators and not technical guaranteers, because there's never a guarantee that these things are always going to work. But you can see this is a really great example of one. However, you can always depend on these things to start forming some sort of a support base if you get a reverse. And so that's kind of how it works. It's pretty simple. And what I've done now is I've selected from our library the bullish piercing line condition. And by the way, the easiest way to do that is to simply hit your / key and start typing part of the name of what you're looking for, and you'll see the bullish piercing line condition. Just click on that. It adds it to your chart as it has here. I'm going to click on this, and I'm going to sort the Russell 3000 with this because I wanted to find some current examples if at all possible. And basically three things happen when you do this in Stock Finder 5. The first is it's going to sort this list and bring to the top of the list any pattern like this that happens on the most recent bar. So my most current examples are going to be right at the top of my list, and they're going to be lighted by the color of the condition itself that you have here at the bottom of your pane. The second thing that's going to happen is below those current examples will be the most recent examples. And you'll see things like 1 bar since true and 5 bars since true. Great way to find it. And I found with candle patterns, a lot of times if you can catch them 1 or 2 candles back, you can still benefit from the reversal pattern. And then the other thing that's going to happen, and you can actually see it on the chart right now, is it's going to color the candle that completes that 2-candle pattern. And you can see that my candle is now white instead of green. And it's done that historically at every point that this has happened on every chart in my watch list in the Russell 3000 throughout its history. So I can just start flipping through charts, and every time I see a white candle, I know that I'm dealing with that piercing, that bullish piercing. Now, I've just sorted 3,000 candles, and we don't have any current examples of this condition, so we don't have any lights. The most recent example that we have comes to the top of our list, Ambassadors Group, EPACS. It was 2 bars ago, and of course you can see the big white candle I'm going to zoom out a little bit, at the bottom of a downtrend. Not a particularly great example to me of the downtrend, but certainly a very big example of the pattern itself with the big gap down, bulls driving it up into the bearish candle and getting more buying the next day, which is really ideally kind of what you want. So at the top of my list are those examples. Here's 2 bars ago. Electro-optical sciences, that was 3 bars ago, and again you see the big downward candle. This really is bearish in this move down. You get the big bearish candle, you get the huge gap down. You're really flushing out the last of the sellers on a candle like that. And then you can just keep space barring through, and you'll see the examples of it. Most of them at the end of the chart. This is a great example here. You get the gap down after this long downtrend. You get a very nice bullish candle way up into the bearish candle and a really nice reversal after that. Now, one of the things I said is some of what strengthens the candle are these conditions like volume. So I added volume surge, and I added a condition and built a mini scan here that I'm going to show you. It's just a 2-condition sort, which is the bullish piercing condition that we're just looking at, and then a volume surge of greater than 2 times the average volume, so that this bullish piercing pattern would happen on at least twice the normal volume. And so what I'm going to do is actually pull up a second watch list. I actually ran this scan and found a few examples, and I'll just pull up those for you. EPAX, the most recent example we had in the Russell 3000, is an example of that. You can see that the volume surge is at least 2 times greater. It's actually about 2.5 times greater. Those are the kind of characteristics, and in fact, having 2 candles like this with the long negative candle also being on way above average volume, that's really a nice pattern to look for. You get strong volume, at least strong relative volume on the 2 candles. It's kind of strengthening your signal. And so these are some.
The other thing.
Go ahead.
Sorry, but before you jump to Mila, I just wanted to say, well, the other thing about EPAX is that that gap on the open is right around a previous support zone, or what's becoming a support zone as well. So yeah, so that's even more.
Yeah, we were talking about this in the class in Philly when we talked about candles this past weekend, was how much that plays into looking at candle patterns. If you get a candle reversal like this and it's sitting on a major moving average, or it's sitting on a point of support like that, that's another way that you strengthen the signal itself. Here's another really bearish pattern from this little island that formed up here. We come way back, we get the bearish candle. Notice how large the bullish candle is, and it's on at least, well, almost three times the average volume. So you can combine these candle patterns with conditions that you build in any other way, including real code conditions. Here would be another example, and I actually like examples like the one you see here on Joe. I kind of like having a little bit of a tail at the bottom like that, simply because it just illustrates that you're really fleshing out the last of the sellers. And then here's the point Julia was making as we talked before. Notice that we get a bounce, we pull back right to that level, and then we take off. So there's a very nice point of support that's created there on that particular stock. And then one last example. Here's this huge breakup here. Great example of the pattern right in this area. And then you get a nice, really nice bounce after that, actually gapping back up. And this is a real change in the mentality of the traders about this particular stock. So just some examples with that volume condition mixed into it. And of course, I could click on that and sort my list just like I did with the individual condition.
Bert said that Amazon is actually also a good example if you want to jump over to Amazon real quick.
And I'm not getting the no, I'm not getting the signal. Notice there's no white candles. That's how we know the condition's not there. I don't see it. This big candle is not coming after the bearish candle. If you had a long bearish candle there, that you might have that condition, but you don't. And that's kind of it. It's a pretty simple pattern, much like the bullish engulfing. But it does have a really nice effect, especially if you can catch it on some volume and at a point of support like that.
Before I grab the presenter rule, Michael, will you go ahead and show just one more time what it is that you included in your extra scan?
In the scan, it's really just two simple conditions. And can you see the condition box here, Julia? The edit condition window? Okay. It's just the standard bullish line pattern from the library. And I just added a volume surge condition, and that volume surge condition is simply greater than 2, which is greater than 2 times the average volume. So even if I'm on a lower volume stock, it's still significant because it's a high relative volume. One other quick thing that I did on that, I'm going to pull up my edit window for the condition from the library. There's 2 parameters. Can you see that edit condition window, Julia?
Yeah, it's a little glitchy, so just take it a little bit slow, but I can see it right now.
Okay. The new low period that you see there, I have set to 20. We defaulted, I believe, to 10 in the library. That's a variable that you can set depending on how deep you want the pullback to be. And then the second parameter you can set in this is the minimum body percent long day. That is what gives you basically the big candle piercing up into the previous candle. So both of those are parameters that people can play with depending on what they want this pattern to look like. I did extend the time period, the new low period, to get a little deeper pullback before these particular patterns.
I don't know 100% if this is going to be, if we're going to be able to see what Mandeep is talking about, but if you jump to JOE on June 25th, he says that there's a piercing pattern that's not highlighted, and I suspect that I might know why that is, so I just wanted to see.
So you're looking right here?
Yeah, June 25th. So my guess is that that first candle is not, the body of that first candle doesn't represent 70% of the overall size of the trade range, which is one of the criteria that has to be true.
The other part of it, Julia, is that the way I have that condition set up, remember, is asking for a 20-bar low on the bullish piercing, and that's not a 20-bar low because it was lower than that within 20 bars. So it didn't.
Yeah, it's only like a 15-bar low.
Exactly.
That's why I'm in deep. Good call, though.
So,
good call.
Yeah, it's great eye to see it. But and if I had defaulted to the 10-bar low, it would have shown up, I'm sure.
Yeah, probably so. Okay, so I'm going to grab that presenter role, Michael, and what I'm going to do is cover kind of what works out to be the opposite, actually, of what Michael just talked about with the piercing. And Michael, when you can see that, if you'll let me know, I would appreciate it.
Got it.
Okay. Now, as Michael talked about, one of the things that's important about either of these two patterns is that they happen during pronounced uptrends or downtrends, depending on the pattern that we're talking about. The pattern that I'm going to be discussing is the dark cloud cover pattern, and we locate that in the same way that Michael located his piercing pattern in order to add it to the chart. So I'm just going to go up to this Add Indicator and Condition to Chart button, and it's just located within the library of all of the other conditions, all of the other candle conditions that you can add. So these are all the candle conditions like Michael showed you, and the dark cloud cover is one of those. It's one of the bearish candle conditions, and what we're specifically looking for is certain behavior that takes place between two consecutive candles that happen on our chart. I'm looking at a daily chart right now, so these are daily price bars. Notice that the example that I have pulled up right now on HCBK actually is not a great example, if only because we're not really in a pronounced uptrend. As Michael showed you when he looked at his edit window, there's a period associated with these conditions. And for him, he set his to 20 bars. He said he has to be making a new 20-bar low in price in order for his bullish condition to trigger. In this case, I have mine just set to the default 10-bar period. So that's why this can be allowed to show up as a dark cloud cover, even though it's not part of a really long, pronounced uptrend as this is happening. So obviously what we're looking for to see happen is a reversal of an uptrend that's in place. So I'm going to go ahead and zoom in on this and just show you exactly the opposite of the piercing pattern is what we're looking for. So we're looking for a relatively large, pronounced white candle for the first bar. So we're going to have an open that's lower than the close, or close that's higher than the open, if it's easier for you to think of it that way. We're going to have the same kind of gap, but in the opposite direction as Michael was discussing with the piercing. So in the case of the dark cloud cover, we're going to look for our open to be higher than the high of the previous candle, as you can see here. And this one's got a little bit of a top tail, so we can see that the prices worked their way higher at some point during that day and then began to fall. And you can see that the close it surpasses the 50% mark with relative to the first candle in the sequence. So you can see here, this is about 50% of the first candle here, and our close falls below that. So we're looking for basically our second candle to pierce to the downside, and it's called the dark cloud cover because it is an ominous sounding name, I'm guessing. In the literature that you'll read about this particular candle pattern, and just in general for the bearish patterns, what we find is that while it's nice to have confirmation for the following candle, it's less necessary on a bearish pattern to have confirmation than it is on a bullish pattern, because it's easier for a stock's price to fall just sort of by trading physics than it is for a stock's price to move higher because of people's tentative natures and because there are more people who are going long on, or who prefer to go long on stocks than prefer to go short on these stocks. But anyway, as we see here, this one is a good example of the reversal that takes place here. We had prices working their way higher. We had the criteria that were met. If you look here at the volume that took place on these two particular bars, you notice that on the first candle of the formation, we don't have very high volume at all relative to what the volume for HCDK is typically. But on the second candle of the formation, which happened here on the 21st of June, you see that you have an increased volume that's actually higher than it had been for some time right back here. So that's also a good sign, as Michael mentioned. There are several things about one of these pattern formations that make it a stronger formation than maybe another that we might see happening, just as Michael was discussing as well. So a lot of these just happen in the opposite direction, just things for you to think about. First of all, the first thing we want to think about is, to what degree is this second candle penetrating the action of the first candle? The more the penetration of the first candle, the stronger the signal typically is. And especially if you have very large candle sizes that you're actually working with, that tends to be the case. The second thing is, be on the lookout for candles that form shaven tops and shaven bottoms, especially here on this second formation. If we didn't have a shadow on the top or a shadow on the bottom, that would mean that our candle opened at the very highest high of the bar and closed at the very lowest low if we didn't have these shadows. That would be an especially strong signal, something to be on the lookout for. That's not a very common thing, but it's something to watch out for. The other thing that we want to look for is if this second candle jumps up above a previous resistance zone and then falls back down and violates that resistance zone. That's a particularly strong signal for us to look at. And then the very last thing is the volume criteria that we just talked about. The most common things that will strengthen the signal, the most common strong signals, I guess I should say, that you will probably notice are those that have very large bars for the candles and those that have a lot of volume, especially on the second day of formation. So those are the things I would most often look for, but those other things that I mentioned are important things to just keep in mind as you're looking at these formations as they happen. And actually, you might notice here that this would be considered one of the piercing patterns if you had a relatively short criteria for period of time associated with it. You can see that here. That also happened at a previous support zone, so that would make that a particularly strong thing as we worked out and had this doji right here that formed as well. Let's take a look at a couple of examples for specifically for the dark cloud cover. And the first one on my list is FHN. FHN, this one I pulled up because one of the things that is possible for these patterns, this is actually just two pretty good examples here. This is the example that I pulled it up for right back here. Okay, so we have a more recent example than that, but I'm going to go back to this more historic example right here. We had been in a relatively pronounced uptrend here. And you can see if I zoom back that that was actually the highest that that price had been in a very long period of time for FHN. Now, what you notice happen here are several things. The first thing that's happening is you have volume that is climbing as these last candles up here are forming. So that's a good sign that our volume is kind of holding steady here. And then during the formation of this pattern, what you notice is that you have a little bit a relatively strong amount of volume here, but you have even stronger volume that's higher than it had been for, I don't know, maybe 10 or 15 bars that formed for the second formation of that candle. So as Michael mentioned, that's an important thing because we're looking at what could be kind of a shakeout that's happening there. So people are getting a little bit nervous as they see this happening and they're acting upon it. And then the next thing that we see happen here is that we have a major gap down. So obviously there was downward pressure that was happening there. As we move our chart forward, what you notice is really we had a gap down and then our price worked its way back up and used the open of that gap down candle as a resistance zone before it continued its downward pressure and its downward move in the price. So FHN's historical example is a relatively good example of what it is that we're looking for in terms of the volume and in terms of the actual formation and the way that we want our price chart to look as this formation is happening. The other thing that I wanted to just note here, though, was that even though this particular signal is not happening in a pronounced uptrend, what we do see is that that price, that reversal that's happening there, is toying right here with this previous congestion level. You can see that these prices really held significant points right back here for these 4 bars or so, and that reversal happened at that point. The other thing I want to mention about this formation is something that was previously mentioned as well, which is that this pattern that formed, this piercing pattern that formed, or excuse me, this dark cloud cover that formed became a resistance zone. So you notice here that the price worked its way back up to this price area around 1250 or so and then reversed again. And what you saw here was price working its way out of basically kind of a lateral situation where we have a resistance zone that's now formed and we have a support zone that we're looking for as well. So that's FHN. EIX also has a pretty strong example that I want to show you. And I realize that we're working on borrowed time here, so I'll try to be careful here. The reason that I pull this chart up for EIX is because this is one of my favorite formations in terms of the long-term price picture. Notice here what's happening to price on a daily chart across this period of time. What you actually notice is that you've got a little bit of an ascending channel that's happening across that period of time. So you have connectable tops, connectable bottoms, and they're getting narrower. They're doing what I would call coiling across that period of time. But if I find candle patterns that form either at the tops of these coiling patterns or channeling patterns or at the bottoms of them, what I find is that I like them because I have definable targets to the top side or to the downside depending on whether I'm at the bottom of the channel or at the top of the channel. Meaning that if I play this particular example on the downside, to the downside, and I'm going short, then I have a definable target for my bottom because I've got a channel that's in place there. So that's a particularly strong long-term formation that I like to use in combination with candle patterns. And the reason I bring that up is because I'm not necessarily only ever looking for strong linear uptrends that are happening that don't have much movement. This one's got lots of volatility that's happening over a long-term period of time, a relatively long-term period of time. We're working from May of 2009 into September of 2009. So we've got several months there of a move that's happening, and that's happening with quite a bit of volatility, and that volatility actually works out to our benefit in this particular case. Okay, so the other thing I just wanted to mention briefly is the way that Michael set up his scan to include additional conditions, I think is something that a lot of you will probably want to do. So just think about I'll just quickly show you how you might go about doing something like that. For instance, what you'll do, let's say that you wanted to look for confirmation of this kind of pattern. This is the dark cloud cover pattern. I'm only requiring it to be at a 10-bar high before to actually be triggered and be displayed on my chart. But if I wanted to look for bearish dark cloud covers and require confirmation, let's say, what I would really be looking for is for this kind of pattern here, and then for my price to move down. That would mean that I would be looking for a close that closed lower than the close of the second bar of this formation. This is just an example of how you can combine your conditions together. What you would do is create your secondary condition. So my secondary condition is that after this happens, this condition happens, I want to see my price move down. So I'm going to go ahead and create a condition based on my price action. So I'll right-click on price, create a condition. What I'd like to see happen is price history needs to move down. It needs to move down at all, and that's going to have this color. That's fine. That just puts an additional condition on my chart. And then remember, when I want to combine my conditions, I can take one of my conditions and I can drop it on another one of my conditions to create my combination or my sequence. In this case, it would be a sequence. I would set it up with a name, with a span in bars, and I would go ahead and scan for that there. Okay, so that's kind of the idea behind how you would create your conditions, your combination conditions. And then it all becomes one condition sitting on your chart. Okay? All right, were there any questions that I could answer, Michael, or do you want me to look over some?
Yeah, there's a couple of things I wanted to talk with you about. Go back to your first example, the FHN, I think it was.
Okay, 1 second. Okay, FHN. FHN wasn't the very first one, but HCBK was. Is that the one that you wanted?
Yeah, FHN is the one I was wanting to look at.
Okay. Let me pull my chart current. Okay.
And that example that you gave me, there's two things I wanted to talk about. One is that example at the very top that you liked so much. You know, when you scan for these conditions, you might not find that condition every day. You might not find a condition like that for 3 or 4 days afterwards. But by sorting the way you are and seeing the recent examples, see, we could have still traded that successfully up to a week after that particular example. It gapped down and then bounced back up, like you said, to support. We could have still gotten in on that and still picked up a really nice part of the fat of that trade. So it's important for people to realize you don't have to catch these candle patterns necessarily, you know, the day it happens, the day after it happens. And, you know, being able to see them within a few days can still provide opportunities on either direction to get into it. And then if you would, bounce to that one that I had pulled up. I think it was HURN for the other end of the spectrum. Let's make sure that's it.
And this is your piercing pattern?
Yeah, it's right over there on the end there. Let's just talk a minute for how you might trade something like this, might actually trade it. If you found that pattern back on whatever that date was, the 6th, 7th, if you had found that pattern, when would you trade it? Well, depending on your risk tolerance, you would probably trade it the next candle. Some people would trade it right at the open, especially if it gapped open like that, moving up. That's a particular pattern. I would have traded that next morning at the open because it was a great looking gap up and continuation of that change of mentality. But if your risk tolerance doesn't let you do that, you might want to let that day develop, trade it the next day, or let partially develop, get past, say, the high of that bullish candle, and then trade into it. But in either way, your trading is probably going to happen the next bar after the pattern. A lot of people try to trade these patterns while they're developing during an intraday basis, and maybe you've got the risk tolerance for that. But at any given point in time, that candle, that bullish candle, could have pulled back and not actually been that reversal pattern. Before the close, you know, an hour before the close, it might have dropped down into the bottom quarter of that bearish candle, and then this pattern wouldn't have been true at all. So really, when
If you,
trading these, you really do have to let these patterns develop, even on an intraday basis. You could easily do this scan on a 5-minute chart or a 15-minute chart, or you could do it on a weekly chart. They work at all fractal levels, but you got to let the pattern develop, and then look at the next candle or two for your trading, depending on your risk tolerance. You got any thoughts on it?
Yeah, if you also notice, this is actually a slow, comfortable formation that happens, or progression, I guess I should say, that happens after this candle formation. So this is an example of one where if you did get in on the candle that followed the formation, that would be on this particular candle right here, since this is the final one of our formation, you notice that your price works higher, but when it does pull back, it's not pulling back in a panicky way that is going to alarm anyone, right? So you're not going to be triggering any stops that you have in place probably. You notice that you're taking it slowly one day at a time, but working your way higher, taking a breather. The breathers that take place are happening in a way that the pullbacks are moving to still comfortable levels. Notice here where your close that pulled back here closed right at this previous close, which is a very comfortable thing to see happen. It didn't penetrate into any of your previous candles that would make you be alarmed about that, and then it's continuing to work its way higher. So you haven't really seen any deterioration in the positive look of what's happening here. And in fact, just now for HURN, you've seen your price work its way into what could work out to be a resistance zone. Don't know if it's going to or not. One thing that I think is an interesting question is, Maggie says, do these candle patterns have rates of success associated with them? And I think that what you'll find with all indicators, and for good reason, is that there's no real way. You can go and back test indicators, of course, and you can back test patterns to find quote-unquote success rates. But the thing that you have to think about is there are a lot of variables at play here. So even though you might be able to come up with a mathematical description of how well a pattern has done historically, what you also have to think about is the things that make a pattern actually actionable to you, probably depend on a list of variables. And in fact, we've talked about a list of those variables, but they're very subjective. So if you saw this formation, you may or may not be comfortable with it depending on how long these bars are, what the how much your piercing pattern actually violated the previous bar, whether you were at previous support or not, the length of the downtrend that preceded it. So it's really hard to come up with historical mathematical descriptions of really success. I would say, Maggie, the best thing for you to do to decide whether you actually buy into patterns is to just spend a lot of time looking at historical charts to see whether you think these are something that could add to your interpretation of what's happening to price patterns. And one of the things that's going to help you do that is the ability to paint your price with your conditions. So all you'll do is just take your condition, just add any of those conditions, paint your price historically, and what I like to do is zoom out to get a pretty big perspective, and then just look for historical examples. So then I just kind of space bar through my list, and I look for either current examples, like Sprint is a current example of my dark cloud condition that I have here, and we actually have several conditions in the S&P 500, or several stocks, I guess I should say, in the S&P 500 that pass with the dark cloud cover condition. So I'll space bar through those and take a look at them, and specifically spend time looking at the historical passers, because those are the ones that are going to tell you whether you believe that you have a comfortability with relying on a pattern like this to tell you something about what you expect to see price do moving forward.
Quick question, Julia. Dale asked if you can see and edit the real code, because all of these candle patterns are written in real code, and the answer is yes, you can. You want to show them how to do that?
Yeah. With any of these, let's actually pull up Michael's piercing line here. I just think it's easier not to have to explain that. Okay, I'm going to go ahead and pull up the edit condition dialog here. And within your edit condition dialog for any of these is going to be an edit real code button that you can press. And what that has is the real code that was written in order for the condition to be created and put into the library. But Dale, any of that can be adjusted by you. So you see the original saved kind of library version of the condition here. But if you choose to alter that, you can alter it and you can actually save it under a separate name. And that will just save it to your My Conditions area within within this up here. So right here you have, when you go up here to add an indicator or condition, you have several headers that you can see here, my indicators, my conditions. If you altered one of those real code indicate or conditions and you saved it, it would then be resident here in this library of my conditions, and you'd be able to pull it up there just like you would any other condition in the future.
Another interesting question. I hadn't even thought of this before, but building an index on the candle pattern and then deciding, looking back historically and seeing, if 5% of the market has that candle pattern, because you did see that a few weeks ago in the bullish engulfing. I noticed in Philly teaching on it was just one after another, unusual amount of them on the same day. I'd never thought of that, but you could build a market indicator on your bullish or bearish pattern, and it will show you either how many or what percent of the stocks in a watch list are creating that pattern on any given day in the history of the watch list. So you can see if the market is doing it, does that cause that formation to happen a lot? It's an interesting concept, Dale. I never thought of it.
I've done that with the engulfing patterns, and it does turn out that there's some amount of correlation. Michael, one of the common index examples that we use is percents of stocks that are making new highs or new lows, because those tend to be really good, strong 1 or 2 bar markers of specific turns. They tend to mark actual tops and actual bottoms relatively closely. These candle patterns, I've not stumbled across any. I've only ever done it with the engulfing patterns and I believe the harami patterns. And what I found is that while on the longer term meaning within 5 bars or 10 bars, they tend to be good markers of tops and bottoms. I don't find that they mark the tops and the bottoms as nicely in the indices and in ETFs as some of the other indices that you might choose to build. But that's something to play with, definitely, Dale, and maybe you'll stumble across something or a parameter that makes it stronger than I've been able to do, but I haven't noticed that it's been particularly strong.
The other thing I noticed on one of your charts that you were flipping through, you had some fibs drawn on it, and the fib level lined up exactly with your pattern that you're working with today. Another example of that would be looking over in freestockcharts.com at volume at price and seeing if the volume at price lines up with the pattern as well. Those would be 2 other ways to look at support or resistance.
Yes, Sprint's actually been behaving according to this fib for a while. I've had it on this chart for quite some time since this uptrend that was in place, and you notice that it's been toying, especially with this original lowest fib level right here, and we saw pullbacks that have a couple of times pulled back right to and consolidated right at one of these Fibonacci levels. So that's just an interesting side note.
Well, that's all the questions I've got for you. I guess we're about that time, aren't we?
It looks like it. So next week we're going to be doing another webinar. Michael, you and I are both going to be doing that, correct? And I believe that we're going to be doing it on either Morningstar data or Zacks data. So we'll get that posted up tomorrow, and if you guys want to join us for it, we'll be here at 8 o'clock next week as well. And as always, we're going to archive tonight's webinar, and that'll be available at the website, either warden.com or stockfinder.com. Sometime tomorrow morning, so you can download it and look at a recording of it if you're interested in having that. All right, so thanks everybody, and thank you, Michael, and thanks for the warm wishes, everybody, too. That was very nice of you, and we'll see you next week.